Imagine waking up tomorrow morning, picking up your phone, and seeing a notification that says you've just earned $487 overnight. You weren't working. You weren't sitting in an office. You weren't even awake. Yet your business made money while you slept. For millions of people around the world, that's the dream behind owning an Airbnb. Over the last decade, Airbnb has completely changed the way people travel. Instead of staying in hotels, millions of travelers now choose apartments, vacation homes, cabins, and unique stays booked through Airbnb. As a result, thousands of ordinary people have turned their spare rooms, or even entire properties, into businesses that generate income every single month. But if you've spent any time on social media, you've probably seen people claiming they make $10,000, $20,000, or even $50,000 every month from Airbnb. It sounds almost too good to be true. And that's because sometimes it is. What those videos rarely show you are the empty booking calendars during the off-season, unexpected maintenance bills, expensive furniture replacements, guests who damage your property, rising mortgage payments, increasing insurance costs, and cities that suddenly introduce new regulations restricting short-term rentals. These are the realities that separate successful Airbnb hosts from those who eventually give up. So the real question isn't whether Airbnb can make money. We already know it can. The real question is, how much money does an Airbnb actually make after every single expense is paid? More importantly, if you decided to start today, how much money would you need? How long would it take to recover your investment? And would this business actually be worth it in 2026 and beyond? That's exactly what we're going to find out. In this video, we're not selling you a dream. We're not going to promise passive income or overnight success. Instead, we're going to break this business down exactly the way investors do. We'll calculate the startup costs, estimate the monthly revenue, uncover the hidden expenses that most beginners completely ignore, and finally calculate the realistic annual profit you could expect from owning an Airbnb business. By the end of this video, you'll know whether Airbnb is truly one of the smartest investments you can make, or whether it's simply another business that looks far easier on social media than it is in real life. And trust me, one number determines almost everything in this business. It decides whether you make thousands of dollars every month or struggle to pay your bills. Most beginners don't even realize how important it is until it's too late. We'll reveal exactly what that number is later in the video, because once you understand it, you'll never look at an Airbnb business the same way again. Before you can earn your very first dollar from Airbnb, you have to answer one important question. Where is the property coming from? This is the biggest decision you'll make because it determines almost everything else: your investment, your monthly expenses, your potential profit, and even your level of risk. Most people assume every Airbnb host owns the property. In reality, that's only one way to start. Many hosts purchase a home or apartment specifically for Airbnb, while others lease a property from a landlord and legally operate it as a short-term rental through a strategy known as rental arbitrage. Some investors even convert vacation homes into full-time Airbnb businesses. Different strategies, different risks, but the same goal: generating consistent cash flow. If you're buying a property, your biggest expense will obviously be the purchase itself. In many cities across the United States, an Airbnb-friendly property can cost anywhere from $300,000 to over $700,000, depending on the location. In premium tourist destinations, prices can easily exceed $1 million. Most buyers won't pay the full amount up front. Instead, they'll make a down payment, typically between 10% and 20%, and finance the rest with a mortgage. At first glance, that might sound manageable, but the mortgage is only the beginning. Every month you'll also need to cover property taxes, homeowners insurance, maintenance, HOA fees if they apply, and interest payments. Suddenly, your monthly fixed costs become much higher than most new investors expect. Now let's look at the second option: rental arbitrage. Instead of buying a property, you rent one from a landlord who allows short-term rentals. This approach dramatically reduces the amount of capital required to get started because you don't need a massive down payment. However, you'll still need to pay security deposits, several months of rent in advance, furnish the property yourself, and ensure your lease specifically allows Airbnb operations. If it doesn't, Your business could be shut down before it even begins. An empty apartment doesn't generate bookings. People don't pay hundreds of dollars per night for empty rooms with white walls and no furniture. Guests expect an experience. They want a comfortable bed, a stylish living room, a fully equipped kitchen, high-speed Wi-Fi, quality lighting, smart TVs, clean bathrooms, attractive decor, and thoughtful details that make the property feel like a home instead of just another rental. This is where furnishing costs start adding up. A one-bedroom Airbnb can easily require $10,000 to $25,000 for furniture, appliances, mattresses, linens, kitchen equipment, decorations, security devices, and small finishing touches. Larger homes can cost significantly more. Every dollar spent here is an investment in attracting better reviews, higher nightly rates, and repeat bookings. Then come the hidden startup expenses that many beginners completely overlook. Professional photography is almost mandatory because your listing photos are the first thing potential guests see. Poor photos can dramatically reduce bookings, no matter how beautiful the property actually is. You'll also need smart locks for self-check-in, smoke detectors, carbon monoxide alarms, fire extinguishers, cleaning supplies, backup linens, internet installation, utility deposits, and sometimes even local permits or business licenses depending on the city. And we haven't even talked about insurance yet. Traditional homeowners insurance often isn't enough for a short-term rental business. Many hosts purchase specialized short-term rental insurance to protect themselves against property damage, liability claims, and unexpected incidents involving guests. It's another cost that many first-time investors fail to budget for until it's too late. By this point, something should already be becoming clear. Owning an Airbnb isn't simply about buying a house and listing it online. It's about building a hospitality business from the ground up. Every decision, from the neighborhood you choose to the quality of your furniture, directly affects your future revenue. And here's where things become even more interesting. Even after spending hundreds of thousands of dollars on the perfect property, beautifully decorating every room, and creating a professional listing, none of that guarantees you'll actually make money. Because the next factor is the one that determines whether your Airbnb becomes a profitable business or an expensive financial mistake. In the next section, we'll calculate exactly how Airbnb hosts generate revenue, what occupancy rate really means, and why two nearly identical properties on the same street can end the year with completely different profits. Now that we've covered the startup investment, it's time to answer the question that matters most. How does an Airbnb actually make money? Most people think the formula is simple. Buy a property, list it on Airbnb, wait for guests to book, and collect the money. But in reality, the business is far more complex than that. Two properties with the exact same number of bedrooms located on the same street can produce completely different incomes. The difference isn't luck, it's economics. Every Airbnb business is driven by three key numbers: your nightly rate, your occupancy rate, and your operating expenses. If you understand these three numbers, you'll understand almost everything about this business. Let's start with the nightly rate. Your nightly rate is simply the amount a guest pays to stay at your property for one night. Depending on the location, season, and quality of your listing, this could be anywhere from $120 to over $500 per night. Luxury cabins, beachfront homes, and properties in major tourist destinations often charge much more, while apartments in smaller cities usually charge less. But setting a high nightly rate doesn't automatically mean you'll earn more money. In fact, many first-time hosts make the same mistake. They see similar properties charging premium prices and assume they should do the same. The result? Their listing receives fewer bookings because travelers compare dozens of options before making a decision. An overpriced property often sits empty while nearby competitors continue welcoming guests. That's why experienced Airbnb hosts focus on something far more important than price alone: occupancy rate. This is the single most important metric in the entire business. Occupancy rate tells you how often your property is actually booked. If your Airbnb is occupied for 21 nights out of a 30-day month, your occupancy rate is 70%. If it's booked for only 15 nights, your occupancy drops to 50%. That difference may sound small, but financially, it changes everything. Let's imagine your average nightly rate is $250. At a 50% occupancy rate, your property is booked for around 15 nights each month. generating approximately $3,750 in monthly revenue. Now increase your occupancy to 80% without changing your nightly rate. Suddenly, your monthly revenue jumps to nearly $6,000. Nothing about the property changed. You didn't buy a bigger house. You didn't renovate the kitchen. The only thing that changed was how many nights your property stayed occupied. That's an increase of more than $2,000 every single month, simply because more guests booked your listing. And this is exactly why professional Airbnb hosts spend so much time optimizing their listings. They invest in better photography, faster response times, competitive pricing, and 5-star guest experiences. Not because they enjoy doing it, but because even a small increase in occupancy can add tens of thousands of dollars to their annual income. However, there's another number that many beginners completely ignore. Average length of stay. Imagine one guest books your property for 7 nights. Another 7 guests each book for just 1 night. Both scenarios give you 7 booked nights, but the workload is completely different. Short stays usually mean more cleaning, more laundry, more guest communication, and more check-ins. Longer stays reduce turnover costs and make the business much easier to manage. This is why many successful hosts actively encourage longer bookings through discounts and special offers. But even if your revenue looks impressive, there's one thing that can quietly destroy your profits: operating expenses. Every booking creates costs: cleaning fees, electricity, water, internet, toiletries, maintenance, replacement furniture, booking platform fees, and unexpected repairs all reduce the amount of money you actually keep. Revenue is exciting. Profit is what matters. And that's exactly what we'll calculate next. Because many Airbnb hosts proudly show their monthly revenue online. But very few reveal how much of that money actually ends up in their bank account after every single expense has been paid. By now, your Airbnb is fully furnished, your listing is live, and guests have started booking your property. Looking at your Airbnb dashboard, everything seems exciting. Bookings are coming in, your calendar is filling up, and thousands of dollars are flowing through your account every month. At first glance, it feels like you've built a highly profitable business. But here's where many first-time hosts make a critical mistake. They confuse revenue with profit. Just because your Airbnb generated $6,000 this month doesn't mean you earned $6,000. In reality, a large portion of that money belongs to someone else before it ever belongs to you. Let's break it down. The first expense is cleaning. Every time a guest checks out, the property needs to be prepared for the next arrival. Bed sheets have to be washed, bathrooms cleaned, floors vacuumed, towels replaced, and every room inspected. Some hosts clean the property themselves to save money, but as their business grows, most hire professional cleaning companies. Depending on the size of the property and the local market, each cleaning can cost anywhere between $80 and $250. If your Airbnb has frequent 1 or 2 night stays, those cleaning costs can add up surprisingly fast. Next come utilities. Unlike long-term rentals where tenants usually pay for electricity, water, internet, heating, and gas, Airbnb hosts typically cover all of these costs themselves. And because guests are on vacation, they often use far more electricity and water than someone living there permanently. Air conditioning runs all day, lights stay on, long hot showers become normal, and heating systems work overtime during the winter. Then there are consumable supplies. Every new guest expects fresh towels, clean bed linens, toilet paper, shampoo, soap, coffee, tea, bottled water, and sometimes even welcome snacks. Individually, these items seem inexpensive, but across hundreds of bookings every year, they become a significant operating expense. Now let's talk about maintenance. No matter how careful your guests are, things eventually break. A chair becomes damaged, a television stops working, kitchen appliances wear out, mattresses lose their comfort, walls need repainting, furniture gets scratched. Every successful Airbnb host sets aside money every month for maintenance because it's not a question of if something will break. It's simply a question of when. Another expense that many beginners forget is Airbnb's own service fee. Every booking processed through the platform includes fees that reduce the amount you actually receive. While guests also pay certain fees, hosts should always account for platform charges when calculating profitability. And then, there are the unexpected costs. Imagine a guest accidentally breaks an expensive dining table, or leaves the air conditioning running for days, or causes water damage in the bathroom. While Airbnb offers certain protection programs, experienced hosts know that not every situation is simple or fully covered. Sometimes repairs take weeks. Sometimes insurance claims become complicated. Sometimes you simply have to pay out of pocket. These unpredictable expenses are one of the biggest differences between a successful host and someone who quits after the first year. Now let's calculate a realistic example. Imagine your Airbnb generates $6,000 in monthly revenue. At first, that sounds fantastic. But after paying your mortgage, utilities, cleaning, maintenance, insurance, internet, property taxes, platform fees, and replacing damaged items, your actual monthly profit could be closer to $2,000 to $2,800, depending on your location and occupancy rate. That's still an excellent business. But it's a very different picture from the $6,000 people often advertise on social media. And that's why experienced investors never ask a property owner, how much revenue does it make? Instead, they ask a much more important question. How much profit do you keep after every single expense? Because that's the number that truly determines whether your Airbnb is a successful investment or simply a very expensive hobby. However, even profit isn't the final piece of the puzzle. There's one last calculation that every serious investor makes before buying any property. It's called return on investment, or ROI. And surprisingly, an Airbnb with lower monthly profit can sometimes be a far better investment than one making significantly more money. Let's find out why. At this point, we've covered the startup costs, the revenue model, and the hidden expenses that determine whether an Airbnb business succeeds or fails. But there's one final question every serious investor asks before committing hundreds of thousands of dollars to any business. How long will it take to get my money back? This is where one of the most important financial metrics comes into play. Return on investment, commonly known as ROI. ROI measures how efficiently your investment generates profit. It doesn't matter if your Airbnb earns $2,000 a month or $20,000 a month. What matters is how much money you had to invest to achieve that return. Let's compare two investors. The first investor buys a luxury beachfront property for $1.2 million. After all expenses, the property generates around $80,000 in annual profit. Now meet the second investor. Instead of purchasing a luxury property, they buy a smaller apartment in a growing tourist city for $350,000. Their annual profit is only $45,000. At first glance, the luxury property appears to be the better investment because it earns more money. But when you calculate ROI, the picture changes completely. The second investor is generating a much higher return relative to the amount of money invested. In other words, every dollar they invested is working harder. That's exactly why professional investors don't chase the biggest revenue. They chase the highest return. This way of thinking completely changes how you evaluate an Airbnb business. The goal isn't simply to own the most beautiful property. The goal is to own the property that creates the best balance between investment, risk, and long-term profitability. Once hosts achieve consistent profits from their first Airbnb, many begin thinking about expansion. Instead of buying one expensive property, they often build a portfolio of multiple smaller properties spread across different locations. This strategy reduces risk because if bookings slow down in one city due to seasonality or changing travel trends, income from other locations can help stabilize the business. Some experienced hosts take it even further. Rather than managing every property themselves, they hire professional cleaning teams, virtual assistants, guest communication specialists, and property managers. Their business gradually transforms from owning a single Airbnb into operating a hospitality company. At this stage, they're no longer working in the business every day, they're managing a system. But scaling also introduces new challenges. Managing multiple properties means handling more bookings, more guest communication, more maintenance requests, and significantly higher financial responsibility. A single negative review on one property may not have much impact, but poor management across several listings can quickly damage your reputation and reduce future bookings. And then, there are external risks that no host can fully control. Governments can introduce stricter short-term rental regulations, Mortgage interest rates can rise. Tourism can decline during economic recessions. Natural disasters, travel restrictions, or unexpected global events can reduce bookings almost overnight. Successful Airbnb investors understand that these risks are part of the business. Instead of ignoring them, they prepare for them by maintaining emergency funds, keeping debt under control, and avoiding overexpansion. Because the biggest mistake isn't buying one Airbnb. The biggest mistake is assuming that the good times will last forever. The most successful investors plan for difficult years while everyone else is celebrating the profitable ones. So, is Airbnb still worth it in 2026? The honest answer is yes, but only if you treat it like a real business. Airbnb is no longer the easy money opportunity it was a decade ago. Competition is stronger. Guests expect better experiences. Regulations are becoming stricter, and operating costs continue to rise. However, for investors who carefully choose the right location, understand their numbers, control their expenses, and consistently deliver excellent guest experiences, Airbnb can still generate strong long-term cash flow while building valuable real estate assets at the same time. The opportunity still exists, but success now belongs to those who approach it with strategy instead of emotion. And that's the biggest lesson this business has to offer. After breaking down every major cost, every revenue stream, and every financial risk, one thing should be clear by now. Owning an Airbnb is not a passive income machine. It's a business. And like every successful business, the results depend on how well you understand the numbers. Many people buy an Airbnb because they see someone on social media showing luxury homes, expensive cars, and screenshots of thousands of dollars in monthly bookings. But those numbers only tell part of the story. What really matters is what happens after the mortgage is paid, after the cleaning crew leaves, after the utility bills arrive, after maintenance is completed, and after every hidden expense has been deducted. That's the difference between revenue and real profit. If you choose the right location, furnish your property professionally, price it competitively, manage your expenses carefully, and consistently provide an outstanding guest experience, an Airbnb can become a powerful long-term investment. Not only can it generate monthly cash flow, but over time your property may also increase in value, giving you two sources of wealth instead of one. However, if you ignore your numbers, underestimate your expenses, or believe that every property will automatically stay fully booked all year round, this business can quickly become a financial burden. The truth is that Airbnb rewards preparation, discipline, and patience far more than luck. The hosts who succeed aren't necessarily the ones with the biggest houses or the most expensive furniture. They're the ones who understand their market, monitor their occupancy rate, respond quickly to guests, and treat every booking like an opportunity to build a long-term reputation. So, if you were thinking about starting an Airbnb business, don't ask yourself, how much money can I make? Instead, ask a much better question. Can I build a business that's still profitable after every single expense has been paid? Because that's the question real investors ask before they risk their money. And if the answer is yes, then Airbnb can become much more than just a side hustle. It can become a scalable business capable of generating consistent income for years to come. Thank you for watching. If you enjoyed this breakdown and want to understand the real economics behind different businesses, make sure you're subscribed to Margin Mechanics. Every week, we break down another business from the ground up using real numbers, realistic assumptions, and the financial principles that separate profitable businesses from expensive mistakes. And in the next episode, we'll answer another question that millions of people have wondered about. What does it actually cost to own a coffee shop? And how much money can one really make? At first glance, it looks like one of the simplest businesses in the world. A few coffee machines, a small storefront, and customers buying drinks all day long. But behind every successful coffee shop is a completely different economic story. We'll break down the startup costs, equipment, rent, staff salaries, daily sales, profit margins, and the biggest mistakes that cause thousands of coffee shops to fail within their first few years. You might be surprised to discover how little or how much a successful coffee shop owner actually earns. Until then, thanks for watching, and we'll see you in the next episode of Margin Mechanics.